Okay, it should be on now. Everything on
All
your back.
right, all right, all right, all right. I think we finally got our technical issues sorted. So, everyone, looks like we're on finally after like 20 minutes of trying. So, hello, welcome everyone. I'm Luke, and I'm going to be on here with Patrick, my good buddy, the co host of Macro Voices and the Market Huddle. Patrick, you want to say hello to everyone?
Well, hello everyone, and welcome to Capitulation Day. It's just right after Liberation Day.
There you
Yeah.
go. There you go. So,
All right.
Patrick, what is going on in the markets aside from things crashing all over the place?
Yeah. Let's just dive straight into it. I'm going to pull up the charts. So, I this trade or this move in the market has more or less been as textbook as it comes, in my opinion. And least based upon our methodology, we saw this coming. We positioned for it. We took close to 500% profits on our put debit spreads. We took we're on our long dated put position. We're already up 300%. We were seeing this market move coming all along. But the thing is that what to do now is the question everyone asks, right?
Yeah.
And so we basically, whether it was on Macro Voices or Market Huddle, we talked about this zone right over here and the failure point as being making the market vulnerable for another leg down. And that
Hmm.
leg down measures exactly to 5,200, where we're exactly trading right now. And now there is vulnerability to all the way to 5,000. That was a previous low from April and of last year, and this could still extend a little bit longer because there's a lot of aggressive selling, margin calls, other things happening in the market. But I'm a buyer here. Let's make this
Hmm.
clear. Like this to me,
Hmm.
we made our money off the shorts. The
Hmm.
thing is that if someone didn't sell 6,000, didn't sell at 5,800, didn't sell at 5,600, didn't sell at 5,400, there is no asymmetry of
Hmm.
making the decision to sell down here 52. The fact
Okay.
is that this decline has now been basically a 17% decline in a span of 44 days,
Hmm.
right? And now I want to use an analog. So let's make this clear. We're buyers here.
Hmm.
We're issuing some buys at Big Picture Trading. Our members are and a cash flow compounder. Our members are not only taking all their profits on their puts, but they're also subsequently now positioning themselves to take advantage of a market bounce. So I want to go back to 2007, 2008, and use the this analog as a basis for everyone online to understand how this is potentially different ways that this could play out, and why I think a short-term buy is interesting. So I want to highlight here was that after that first market top, the market dropped about 21% in a span of 105 days, including in the final leg of this. It was a 18% decline in 49 days, right? We just had
Hmm.
a 44-day decline of 17%. So we're proportionally similar in terms of the first drop. I want to highlight that for the subsequent 2 months that followed that initial drop was a rally that lasted 4 months and rose 15% before the next leg of the bear market begun.
Hmm.
And so the point I'm getting at here is that even though it was a bear market and there was more devastation and selling to come, the selling, just from a pure tactical perspective, you turning around and panic selling after it's down 17% doesn't make a whole lot of sense. There's going
Hmm.
to be a point here where this market is going to bounce. And what would a bounce look like? It could very easily, like, okay, first of all, we can go lower first. Like, no, I can't stand here today and say, I know that today is the low, where
Hmm.
it's low enough for us to take profits on our shorts, right? So
Okay.
we're exiting short positioning, dabbling with longs, because to me it's the asymmetry is there. What do I mean by that? Let's even go through a scenario that this market goes to even 4,900 or 4,800 in the next few days, and that the selling does continue. Inevitably, there's going to be a market bounce, very like there was in 2008. These bear market rallies are vicious and long. The
Hmm.
short sellers are long too much, and so short too much. They have to buy back their short positioning, and reflexive rallies happen. And so, one way or another, odds are that the stock market will actually a month or two from now be higher than where we are, even if the next few days still has some pain.
Hmm.
Uh, so for somebody to panic sell today, it's kind of late.
Hmm. Hmm.
This is where you can execute repair strategies. We've talked about repair strategies on a webinar, a big picture trading, just like 2, 3 weeks ago. The video is still available on our members section. But you want to have some way to capture a potential bounce in this market on the upside, and this is what we want to try to capture in this kind of a market condition. Now, that's the S&P. Well, I want to just highlight a couple of things. Number one, the VIX blew out to 44. That is one in itself one of the indicators that some sort of short-term capitulation is happening.
Hmm.
That it means that we're probably days within a low, if not already forming it on that. So it's one of those scenarios where I remain big picture bearish, but on the short term, this leg is likely over very soon, is my position. Similarly, I want to highlight crude oil crashed, and so did a whole series of commodity plays. I view all of these to being buying opportunities as well. So as crude oil finishes this type of a measured move down towards $60, this is where I think actually short-term opportunities to play bounces are actually there. And so to me, I'm actually looking at all of this right now as a buying opportunity on that front. And so yeah, we
So you
is there
feel basically like you have that analogy that you use with an elastic band, right? That it's got to
yeah.
snap back up. So now you feel it's basically stretched to the max, and now it's going to start going in the other direction. And like you were saying, those we did the webinar on Tuesday in terms of if someone's worried about a market crash and the fact that these bear market rallies are just vicious because they can go on for months and they can retrace basically
Yeah,
halfway back up is the most common thing before it resumes the selling.
yeah. And so this is just I mean, we obviously had this kind of panic moment in the markets. This is all happening when you have. Think of when this drop is happening. There's that saying that the market rises on an escalator but drops in an elevator. So we're in an elevator drop. But think of it as the bungee cord analogy, because there's a reflexivity in the markets, which is that often rallies have similar magnitude to the speed and velocity from which the previous drop was occurring. And so if we're in a scenario where crude oils, for instance, drops from 72 to $62, $10 in 2 days, bam, right? Like it's just
Hmm.
down. It could be up $5 in another day, right? Like it's all relative, and so there's maximum volatility here right now, and there's an opportunity that once that bungee cord is finished being stretched, the elasticity that will snap the market the other way, and I think that it's very close.
Okay, okay. So is this a moment that if people are suffering, that they go that let's just say, okay, we collected profits on the downside. And again, remembering the webinar we had done on repair strategies, is this a spot where you would recommend those repair strategies for people that have been hurt?
Absolutely. I mean, we could do an example of a
Ratio call spread?
absolutely. Like we can illustrate something on here. I'm just going to need to load up a data set here.
Yeah,
Hold on.
absolutely. Go for it. So, by the way, you guys, we're going to go through this example in probably lightning fast speed. But if you are curious in terms of just going through it nice and slow, Patrick did do this inside of Big Picture Trading. We literally took the recording down like 2 days ago from the homepage, but it is inside our members section. And you can either join as a member and get access to that video, or you can basically join as part of a free trial and get access to that video. So that video will be inside of our members bonus content section. And it's going to be talking about basically Patrick's repair strategy. We took one of our members who got into Tesla at like 300 and had basically suffered when it continued to go down. And we showed him our repair strategy, which is what Patrick is going to be covering. And he was able to basically get out of the position, even actually at a profit in this particular case. So definitely worth checking it out for those of you that just are getting beaten over the head here during this market and the last basically month and a half as it's been descending. So it will allow you to recoup some of those losses, hopefully even break even. But Patrick will demonstrate that trade in just a moment.
I'm gonna.
Whenever you are
It's
ready.
actually. It's yeah. I'm not able to log in here, so that's okay. What we'll
Okay.
have to do. We'll have to do.
I mean, we can
So we'll
reference people to the video so that they can watch it. I
no, no,
mean,
no. I want to do something. I mean, maybe I'm just gonna load up a live account. Hold on a second here.
all right, go for it. Take your time. In the meantime, if anyone has any questions, or if is there something particular that you wanted to show this on, Patrick? Are you looking for some suggestions from people?
Well, let's see if I can find a real example. But if somebody has a question or something that they want to specifically cover.
Okay. Hold on. Okay.
Okay.
All right. Congratulations, Andy. Andy's asking about the yen carry trade. So we'll show this example maybe first, and then we'll get into some questions.
Yeah.
All right. Do we have any of our Big Picture Trading members here? I'm curious. Do we have any Macro Voices listeners, any Market Huddle listeners? If you guys are interested in tuning in and hearing Patrick on a regular basis, you can do so on those two podcasts. Again, that is macrovoices.com. I'll put that macrovoices.com and markethuddle.com. You can check out those two shows that Patrick does on a regular basis, and Big Picture Trading is Patrick's home. So you guys can check those out if you want Patrick on a daily basis. Are you ready, Pat?
No, actually.
Oh, okay.
But anyway,
When you said all right, I thought you were ready.
Hold on.
All right, all right, all right.
All right. So here's I'm going to isolate. Here's an example of the IWM, which is the small caps ETF. All right, and so it's trading at $180. You can see here that it's a $229 cost base. This position is down for you. This is a simulated one. I just found a position that was sitting in a simulator. And let's say you wanted to put on a repair trade on this. Now, obviously, a repair trade, anticipating it going all the way to $230 on the short term, is not a realistic exit. But let's just say we were looking for a scenario where I wanted to exit out at $200, or at least recover. In this case, let's say $20,000 of the loss, right? So let's just say
Hmm.
this is IWM, and you're saying, I would love to try and get a repair trade that if I can get this thing an exit at $200 and $20,000 less, that would be ideal. So what the whole purpose of a repairs trade is to allow you to basically make the $20,000, but do so from a better positioning where you don't need the stock to rally as much in order to get that return. And so an example here is I'm going to turn around and do a 180 by 190 ratio call spread with the IWM. And so in this example, I'm going to turn around with the 1,000 shares that I own, and I'm going to buy 10 more call options to give myself the upside on this market. I'm just going to illustrate this here this way. And I'm going to simultaneously, so that was $10,000 it cost me essentially to buy that call option. And I'm going to sell 20 of these May 190 calls at 5.25. I'm just going to hit market, and you can observe that they also made me roughly $10,000. So notice here that, Luke, that from a cost-based perspective,
Hmm.
10,000 in, 10,000 out, how much did it cost?
Okay, so
Zero.
it's basically net zero.
Net zero. And because you own the 1,000 shares of stock, none of these call options up here are considered naked.
Right. You're already
Right?
covered.
You're covered. So this strategy that I just did here cost zero and required no margin to open.
Okay, good start.
Right? And what you've done is you created a trade that would allow. Let me. What we'll do is we'll just simulate it in a quick simulator.
So is everyone following so far in terms of the two positions? So it's 10 calls that we bought and 20 calls that we have sold. And they're covering each other in terms of basically how much they cost versus how much premium we are
Yeah, it's
we
just going
are
to take me.
collecting.
I'm just setting it up on the simulator, but
Yeah. Hey Tristan, good to see you. Hey Ricardo. I'm sure we'll have an opportunity to look at JPM. Um, Kitty Squats, BBT subscriber, eating it up today. Wish I listened to my friend who made me bank with the back during COVID. That was a crazy time. Absolutely.
All right, almost ready, buddy.
Yeah, so we'll have everything simulated out so we can basically stress test and see how this could potentially play out in a variety of scenarios. But so far, again, the trade isn't costing us anything, and Patrick will guide us through step by step on how this would work in terms of a repair without having IWM have to go back to where it basically was.
So perfect.
Indeed, Tristan.
This is close enough for the simulation. Okay, so here what we have is I want to just show the stock investor with at 180 on the price of the IWM. You can observe here that it's $180,000 stock only. Investor says, I don't want to put on a repair strategy. I'm only going to turn around and just hold it and hope that it comes back. Now, alternatively here, you can observe that we more or less did this at zero cost. 8,500 in, $9,000 credit in, $8,500 out in the simulation. You saw in the live account when we simulated it, it was very close to zero cost. And the point I want to illustrate is that the reason you open a repair strategy is that if by expiration, right, we chose a May expiration, the stock rallied to 190, notice that the person who just had the shares made back $10,000. But how much did we make back?
20,
20,000.
21.
Right. It cost 0 to open, and we only needed a $10 rise in the IWM to make back $20,000 of the loss
Hmm.
versus the investor. Well, notice here, if this went to 200, well, now this investor, when the stock is at 200, this investor is up the same amount as we were when it was down at 190. In other
Hmm.
words, what we did was we created a strategy that didn't need the stock to rise all the way to 200 for us to get out, like if it was at 200.
Hmm.
We only needed a $10 rise to 190. The point is that a strategy like this allows you to lessen your losses and to put yourself in a position to get out of your trades closer to break even. Now, the a lot of people will say, well, what's the catch? What if the stock keeps going down? Well, if let's say
Exactly.
this went to 170, notice both investors are down 10,000. Why? Because you own 1,000 shares. But notice that the options didn't add risk on the downside. You didn't have a bigger loss than you would have if you didn't do the option strategy,
Hmm. Hmm.
right? The only catch and trade off is you've capped your upside. You can't make even so you make that 20,000 very quickly, but you can't make more than 20,000,
Hmm. So
right?
that's the downside. This is,
That's the
again, a
downside.
repair strategy. It's not
A
about
repair.
being speculative. It's not
Right.
about trying to hit another home run. It's about a mulligan, if you will,
Yeah.
for those of you that play golf.
It's about trying to get out of your position at in some way or another at a reasonable a smaller loss than you're incurring, allowing you the opportunity to kind of preserve some of your capital. And particularly if you're getting very concerned from a bearish perspective on this market, this is this is an environment where you want to be very, very careful, obviously. And if you want to, then on the bounce, you want to get out of as many things as you can. And so a repair strategy allows you to start liquidating positions during market bounces. So I wanted to highlight another asset that has just been going down pretty heavy, and that's silver. And silver basically wiped out $5 on the downside in 2 days. It's been a nasty little drop. And again, this is like a bungee cord. This thing can snap the other way at any one time. And so as it's approaching these previous lows, very interesting place to watch whether or not silver puts in a previous low. The other thing I wanted to touch on was just a huge move that we saw in the SOFR futures. Though now, any of our listeners that aren't familiar with SOFR futures, SOFR futures are short-term interest rates, and essentially think of it like bets on where the Fed will have short-term interest rates in that future point. So, for instance, this is the December 2026 contract, which is basically saying where will Fed funds roughly be? And I say Fed funds because this is the overnight lending rate, but it's very much tied to Fed funds rate. But the point is that what will that interest rate be? And so we went from basically well, they basically priced in 2 to 3 additional rate cuts in literally the last week as recession risks are skyrocketing. And this is what is actually making everyone panic with China retaliating with its tariffs. We now have all this anxiety in the markets about how will this escalate, which has basically caused a lot of that panic. But what's interesting is the long bond is running. So this is the TLT. But one of the things that was my thesis all along was that Treasury bonds this time around will act as an asset that will rally during a period when risk off as risk when we're risk off and markets are dropping. And so this has also been a very successful trade for us along the way, and it makes sense to me because when you are heading toward a recession, an economic slowdown, even though everyone loves using this stagflation term out there because inflation is likely to remain somewhat sticky, the way that I look at it is that at this juncture, uh, inflation is only going to be transitory because fine, tariffs will make prices more expensive on the very short term, but if there's a consumer recession and people have stopped spending and a money supply is not expanding and credit worthiness isn't there because unemployment rates are rising and consumers are strapped, all of these different things, this is disinflationary. And this and it certainly spurs low growth. Those are things where long-term interest rates actually are allowed to be at lower levels, allowing bonds to rise. And so I'm not going to be surprised if we see the TLT trade up to the $100 level in the next little while. Yeah, so anyway, it's a crazy market out there. Things are crashing. Still think it's a big opportunity.
Hmm. Okay. Did anyone? So I saw people were having issues in terms of like TQQQ. Some people wanted to look at JP Morgan. Did you want to have a look at any of those and see if we can answer some of those questions? Ricardo Chilak was asking in terms of thoughts on JP Morgan. I think it's a good time to buy. Um,
Hmm.
what else were we talking? Mike was talking about TQQQ.
So,
Is it good for this strategy as well?
sorry, for TQQQ or just QQQ?
TQQQ.
Um, One second. The that's Ultra Pro Qs. Okay, so that's just like a highly leveraged Nasdaq ETF. I generally, because I am such an avid options trader, I get as much exposure to the market as I want through the options market and enjoy the convexity of that option versus buying double and triple exposure ETFs, which don't give you any convexity, just massive leverage. And so in this situation, I would not normally trade a position like this.
Hmm.
Now, with that said, this is just a play on the QQQ, which is when the Nasdaq hits its short-term low and bounces, the TQQQ will also bounce. They're going to correlate. It's just
Hmm.
it's leveraged. Um, it's the same play. It's the same play as the S&P 500. I think the short-term lows are very close.
Hmm.
And
Okay.
JP
Okay.
Morgan, oh, look, JP Morgan is just a correlated stock to the whole market. The moment the S&P makes its low, JP Morgan will make its low. It's gonna come to the minute, the same time. And so making a call that you want to buy JP Morgan here is the same call as the S&P. It's
Hmm.
basically when the low of the market comes in, JP Morgan's low will come in that same time, and it is the largest bank in the United States with the biggest player out there. So when the market's going to rally and people usually chase after the highest quality names, it's something like this is likely to bounce.
And obviously, people can't see your trades here, but how is it that you are expressing trades? Are you expressing them by getting stocks? Are you putting on any particular types of spreads? Are you going long calls? What sort of strategies do you recommend for these type of bear market rallies, aside from the repair strategies for those of you that are in trouble?
Right. So this is a time where you do want to uh, be careful about just buying calls. With the implied volatilities as high as they are, with the VIX being up at the 40 handle on the upside, buying options outright is incredibly expensive.
Hmm.
So the only real choice is to do some sort of an options combination or just buy the stock itself. And
Hmm.
an options combination such as a bull call spread allows you to buy an expensive option, but also sell an expensive option to offset it, which basically allows you to control that volatility and get and allow you to still participate on the upside. The benefit of a bull call spread is the fact that you're going to have a definable downside risk. And when markets are crashing this way and anxiety is as high as it is, then people are are scared to just go and buy more stock, and so this is where putting on an option strategy allows you to have a definable downside risk, right? And I think that makes people feel more comfortable dabbling here with that, especially if they see a lot of red on their portfolio.
Absolutely. Now, I also know that you are an avid option seller. You love generating income from your
Yeah.
portfolio. Are you implementing any strategies based on income generation at these lows?
Hmm. Absolutely. This is um, this is the perfect time to be an income writer, as far as I'm concerned, because when you have higher implied volatilities. Okay, so let's just pick on Amazon for a moment, right?
Hmm.
So Amazon was trading at $240. Now it's at 175. So the thing has already wiped out a ridiculous chunk from peak to trough. This thing in 2 months has wiped out 1/3 of its value, right? And so, and right now, though, the implied volatility on Amazon has skyrocketed. So let's just pull up, for instance, the volatility lab here. And what you can observe is that the June has gone up to about 44. So first of all, implied volatilities were down in very close to 30% just a few weeks ago.
Hmm.
Now they jumped as high from 44% for the Junes to as much as 60% for an April option. Basically, at the front month, option prices have virtually doubled in their cost, in their value, in the last week. So now Amazon not only is at 30% off of its highs, but turning around and settling an income right at these lower levels, 30% off its highs, are paying you double the income you were getting when it was up at its highs, right? Like this is
Hmm.
you're now being paid for taking the risk, and you're getting and securing the stock at a potentially very favorable price. And so to me, this is a no-brainer time to start income writing.
So it's kind of like, for those of you that are not familiar with what we're talking about, try let me maybe give you an analogy. So options writing is very often like selling insurance into the stock market in this case. And so basically the storm has come, it's done all this damage, and now the insurance company, I mean, what happens in a typical insurance company after a storm, right? Premiums go through the roof because now on everyone's mind it's, oh my goodness, a storm came and all of these expenses, etc. So now the storm has basically run through. We still don't know if it's going to be back, but the skies are kind of clearing. And at this point, you're basically getting paid double as an insurance agency, selling these options into the market. Is that an accurate way of explaining things, Patrick?
Yes. Yeah.
Okay. Hopefully that
And
gives everyone clarity.
yeah. So anyway, I just wanted to come on here live just to say hello to everyone and kind of give everyone my thoughts. I hope everyone enjoyed it. Is there anything that there any comments or questions, or do we wrap
So
things?
we do have a couple of people who wanted to know about the basically yen carry trade and how that is progressing. Do you have any comments on the yen carry trade?
Uh, well, I mean, the yen carry trade, uh, well, the unwind of the yen carry trade was this event back over here. The And basically when
We don't see your. Oh, there we go.
so that was back over here, and since then, the market has been it's stable in that environment. But I'm not sure what reference they're or what they're looking for in that question. But I mean, the yen, U.S. dollar yen, right now is declining, but I don't think that this is a yen carry trade unwind or something like this. Obviously, Japan was a target of some of the tariffs and things like this, which is obviously creating currency volatility. But I don't think that a yen carry trade right here is a big concern.
Okay. So overall, you're anticipating a bounce here, and we've got repair strategies that you can implement in order to fix positions that you have, especially those with liquid options chains. Option selling is something that Patrick is doing right now, and if he's playing this bounce, he's playing it basically with, you were saying, bearer call spreads, right?
Yeah. Look, there's a famous saying. I'll leave it everyone with this. There's a famous saying from, I think it was Warren Buffett, basically, be scared when everybody's brave and be brave when everyone is scared. And up at the market tops, when everyone was so sure everything was going to be fine, everyone was very brave. And we were scared and we were shorting the market. We were basically saying, this is stupid up here. We shouldn't think. But now it's the opposite. Now everybody is scared and everything is selling cheap. This is the time to be brave. I'm a
Hmm.
trader. I'm not a not a perma bear. I'm not always going to be just shorting the market. Shorting the market is only for when the market is out of balance and there's an opportunity to downside. I still think that this is a bigger bear market that can, in the months to come, can still weaken, but a market bounce here is coming, and this is not the time to capitulate and puke out your stocks if you didn't do it already. If you did it like a couple weeks ago, that's fine, but doing it now when the S&P is under 5,200, it's kind of late in this impulse down to do anything.
Absolutely. What else? We got some comments coming in. So Johnny Airport 2 here. Patrick, get your hands on some North Coast Brewing Company Scrimshaw Pilsner for a future market huddle episode. Okay, so obviously a huddle fan. Patrick, haven't traded options long, maybe less than a year. What's your best course to start with? So Andy, you can, I mean, we have a master's program on options. We also have an asymmetric trading program on options. So those are fantastic places to start. And I'll put in for anyone that does want to join Patrick on a regular basis. Patrick's home is basically bigpicturetrading.com. I always want to make sure that I've spelt that correctly. And I'm also going to throw in a link for the repair strategy video that we put up. I think you'll be able to access it there without signing up for ever anything. In the worst case, you guys can sign up for a free trial at Big Picture Trading. Check out those videos. Check out
Yeah,
courses. We have demos. We've got a master program introduction free. There's tons of free content on there, so you can definitely check it out. We're here just to make sure that you guys have basically some clarity in terms of what's going on in the markets, and most importantly, keep that psychological capital intact. Because every presentation we seem to do, Patrick, you talk about not just our capital that is in our accounts, but also our psychological capital, which actually allows us to take the actions or not take the actions
yeah,
depending on how badly we got beat up from a psychological perspective. So
yeah,
everything that we do here at Big Picture Trading is about asymmetric trades, hitting home runs when we're right and suffering paper cuts when we are
absolutely.
wrong. So you guys can check out all of those resources. Anything else? I will just go ahead and add my plug for BPT in case everyone is cautious. Okay. All right. So his moves have paid for my. Thank you so much, Stephen. Subs 10 times. Fantastic. All right. Piotr Stipka, nice to see you from Canada. Any correlation trade between Bitcoin and the QQQs and the QQQs for a short-term bounce? Any comment on that, Pat?
Well, Bitcoin just hasn't crashed in the last few days. So that you want to think reflexivity. The things that have gone down the most will bounce the most. And if Bitcoin didn't dump in the last few days, then looking for it to bounce is not. It's not going to have the same elasticity. The reflexive rally is not going to be there. So, it's great for Bitcoin investors that Bitcoin didn't wash out here, but it's just not where the action's going to be.
All right, fantastic. You guys heard it here. Any final comments, Patrick, before we wrap up for today's little emergency meeting?
Listen, this is turbulent times. I specialize in these areas, like trading these swings higher and lower is what I love doing. And so those that want to, follow along as I try to call all the swings higher and lower of these markets, you know where to find me.
And you've been a master at it, buddy. We caught the Volmageddon, we've caught Christmas Massacre, we've caught COVID, we caught the 2020, the 2022 bear market, and now we've been profiting the entire time down here. So feel free to check us out at Big Picture Trading, and we look forward to seeing you guys there. Thank you so much, everyone. Good
Thanks,
luck
everyone.
in the markets. All the best. Cheers.
Thanks, everyone.